It's January 2026. LuluLemon has just launched a new line of leggings called Get Low. Within 4 days, they're gone, pulled from their website after thousands of customer complaints.
Leggings in the collection called Get Low have been pulled from the LuluLemon American website after customers complained that they were see-through.
The stock drops another 6% after it already fell 50% from its highs. There are national boycotts of LuluLemon products due to leadership. The CEO just resigned.
CEO Kevin McDonald will be stepping down from LuluLemon.
The founder, who withdrew from the company, goes on LinkedIn and calls it a new low for LuluLemon. So, how did one of the most powerful apparel companies in the world go so bad so quick? Let's start with the numbers because the numbers are brutal. At its peak in December of 2023, LuluLemon stock hit $516 per share, valued at nearly $65 billion. By late 2025, it was trading at $157 per share, valued at only $18 billion. That's a collapse more than 68% from its all-time highs and a loss of $47 billion in value. In 2025 alone, the stock fell 57%, making it one of the worst performing stocks of the entire S&P 500. Only Walgreens ranked below it. US revenue, the market LuluLemon built itself in, fell 3% year over year in Q3 of 2025. Comparable store sales in the Americas dropped 5%. The CEO exited without a replacement ready to go. The founder declared a proxy war against the board, and a new leggings line had to be deleted from their website. And to understand how bad this really is, you need to understand how good everything once was. It started in 1998 with a Vancouver surfer named Chip Wilson. He walked into a yoga class, looked around the room at the woman, and saw a problem. Women were working out in heavy cotton leggings that didn't breathe, didn't wick sweat, and didn't make anyone feel particularly powerful. Wilson had spent years working in technical surf and snowboard fabrics. He knew there was a better way. His solution was a performance fabric, Luon, that felt like second skin. Flattering, moisture-wicking, and durable. He called the company LuluLemon and opened one store on West 4th Avenue in Vancouver. Word spread from yoga studio to yoga studio like wildfire. Women weren't just buying the pants, they were buying an identity, a lifestyle, a signal that you were the kind of person who showed up to the mat, to the office, to the school pickup fully put together. The free in-store yoga classes, the ambassador program with local instructors, the shopping bags were printed with self-improvement mantras. LuluLemon didn't just sell clothes, it sold a philosophy, and people paid for it happily. $110 for leggings, prices that felt justified because the product and the community around it genuinely delivered. The IPO came in 2007, which raised $327 million. Revenue crossed $1 billion in 2012. By 2022, the company was pulling in over $8 billion a year and had expanded to over 30 different countries. LuluLemon didn't just grow, it defined an entire category that no one else was in, athleisure, and it dominated it for over a decade. But even during the golden era, the founder was a ticking PR bomb. Chip Wilson had a long, well-documented history of remarks that put the brand's inclusive image in a direct conflict with his worldview. In 2005, he defended excluding plus sizes, arguing it would take too much extra fabric. He made comments at a conference widely interpreted as defending child labor. He printed Ayn Rand philosopher quotes on LuluLemon shopping bags, confusing, to say the least, for a yoga brand built around mindfulness. Then, in March 2013, the company recalled nearly 17% of its entire inventory. The black Luon pants, after customers found they were see-through. Cost of the recall, $67 million. The company handled it well at first. Then Wilson went on Bloomberg TV and said that some women's bodies just don't work for the yoga pants.
Some women's bodies just actually don't work for it.
Pointing to thigh rubbing or obesity as the culprit.
Really about the rubbing through the thighs, how much pressure is there.
The internet exploded. His apology video was addressed to LuluLemon employees, not the customers he had body shamed.
I'm sad for the people of LuluLemon who I care so much about that have really had to face the brunt of my actions.
One shopper wrote publicly, "How about apologizing to the customers he fat-shamed?" Wilson resigned as chairman by December 2013.
Founder and chairman of LuluLemon announces he's stepping down.
CEO Christine Day departed shortly after. Nothing changed. In 2024, Wilson publicly attacked LuluLemon's diversity and inclusion initiatives. The backlash was very immediate. The brand he built was still paying the reputational cost of the man who built it. In 2019, a new CEO named Calvin McDonald arrived and laid out an audacious vision called the Power of Three. Double-digit revenue, double men's revenue, quadruple international revenue, all within 5 years. It worked. LuluLemon hit every single target ahead of schedule, so in 2022, McDonald doubled down. Power of Three became the Power of Three times 2, an even bolder plan to take total revenue from $6.25 billion in 2021 to $12.5 billion by 2026. The company would expand aggressively into menswear, flood China with stores, launch new product categories, and, in one of the most expensive bets in its history, transform itself into a connected fitness platform. "We want everybody sweating on a mirror to be in LuluLemon," McDonald declared on a 2022 earnings call. "And we want everybody sweating with LuluLemon to be engaging and using a mirror." That quote would not age well. To be fair to McDonald and the board, the big bets made sense at the time. It was June 2020. The pandemic had locked the world indoors. Peloton's market value was exploding. Connected fitness wasn't just a trend, it looked like the future of working out. And Mirror, a startup that had built a sleek wall-mounted screen streaming live workout classes, had real promise. For a $500 million acquisition, LuluLemon would become more than a clothing brand. It would become a fitness ecosystem. Meanwhile, the core business was on fire. COVID had made athleisure the uniform of the entire working world. Sales were surging. Margins were pristine. The company was selling 95% of its inventory at full price, almost unheard of in retail. Why not reach further? International expansion, especially into China, was delivering exactly the growth the model predicted. And the Power of 3 times 2 wasn't just ambition. It was math. The company had earned the right to think big. For 2 years, the data backed it up. Revenue jumped from $6.25 billion in 2021 to $8.1 billion in 2022 to $9.6 billion in 2023. McDonald named it ahead of targets. China alone surged 38% in 2024, reaching $1.4 billion. Menswear, once an afterthought, climbed to over $2.6 billion. The stock reflected all of this. Analysts were generous. The brand was beloved. McDonald was celebrated as one of the retail's best operators. Everything looked like an endorsement of the grand plan. The early warning signs were small, but they were ignored. The Mirror acquisition was actually the first tell. By late 2021, barely 18 months after the $500 million acquisition, Mirror's revenue guidance was slashed in half. The at-home fitness boom was over. Vaccines meant gyms were open. Peloton was already crashing, and Mirror, which had no app, no community, and hardware device that cost $1,500, was losing the battle for living rooms before it even started. By Q4 of 2022, LuluLemon quietly buried the disaster in an earnings release, a $442.7 million post-tax impairment charge on Mirror. CFO Megan Frank told analysts that hardware sales came in below expectations and that the overall at-home fitness space remains challenged. The company wrote off nearly every dollar it had just paid. Simultaneously, there were quieter signals from the product side. Focus groups began reporting that LuluLemon felt like a brand for moms, not Gen Z. The leggings dominance was plateauing. Brands like Alo Yoga and Vuori were appearing on her Instagram feed. They were fresh. They were, and this was the word that kept coming up in brand research, cooler. In 2024, LuluLemon's chief product officer, Sun Cho, widely credited as the creative engine behind the brand's best-loved products, departed to join Vans. Wall Street noticed immediately. Shares fell 7% on the day of her departure. One analyst called her the person most instrumental to LuluLemon's success. And the product pipeline, that mattered most, women's leggings, was left without its most important steward. Then July 2024, the Breeze Through. LuluLemon launched a new legging line designed for hot yoga. The Breeze Through collection, priced at $98. The fabric was light, the promise was innovation. The reality was a PR catastrophe. Within days, Reddit had delivered its verdict. One user wrote, "I tried them on and they literally make me look like a rectangle." Another, "All I could see was a whale tail / giant arrow pointing to my crack." The product rated 3.1 out of 5 stars after 112 reviews. The line was then pulled. JP Morgan slashed its price target from $457 to $338. LuluLemon stock closed down 9.1% on a single session, hitting a new low of $247.32. The stock was now down 50% year to date in 2025. That made it the second worst performing stock in the entire S&P 500 in 2025. At the same time, the numbers from the US business had turned genuinely alarming. The Americas, the market that built the company, the market that still accounted for 68% of total revenue, had gone negative. Comparable store sales dropped 5% year over year. Full price sell-through collapsed from the historic 95% down to 75%. Store shelves began filling up with bright green, neon yellow, and orange pieces that had nothing to do with the clean, muted palette that loyal customers loved. Then came the competitors. Alo Yoga was opening stores directly next to LuluLemon locations on 5th Avenue and every premium mall in the country. Vuori, backed by $825 million from General Atlantic, was eating LuluLemon's lunch with men who loved its softer fabrics and California casual identity. Credit card data from Earnest Analytics showed LuluLemon's own customers were shifting spending to Alo over time. Once they bought their first Alo piece, LuluLemon spending began to decline and never fully recovered. Jefferies analyst Randy Conant put it plainly on CNBC. The data alone proves that it is a market share issue. December 2025, LuluLemon announced that CEO Calvin McDonald was stepping down effective January 31st, with no successor named. The board named the CFO and Chief Commercial Officer as co-CEOs. A structure of co-CEOs has rarely worked in corporate history. Then January 2026 arrived, and the brand launched the Get Low collection. 4 days later, Reddit said the leggings were see-through when bending again. The company paused online sales. Chip Wilson posted on LinkedIn, "This is a new low for LuluLemon. The company has completely lost its way as a leader in technical apparel." 3 separate see-through legging scandals in 2013, 2024, and 2026. From a brand whose entire identity is built on technical fabric quality, that's not bad luck, that's internal failure. As of early 2026, LuluLemon is a company in potential turnaround. The founder is waging a proxy battle.
The straight LuluLemon founder, Chip Wilson, is launching a proxy fight at the athleisure company in an effort to shake up the board.
Activist investor Elliott Management, which holds a stake of nearly $1 billion, is pushing for new leadership and reportedly backing a former Ralph Lauren executive as the next CEO. The brand still generates over $10 billion in annual revenue. It still dominates premium athleisure in most of the world outside the US. China is growing fast. There's a real business here, one that would make most apparel brands envious. The board said it's committed to finding the right CEO. Chip Wilson says they won't find the right CEO until they change the sitting board members. Elliott says it's ready to push harder. The balance sheet says LuluLemon will survive, but the culture, competition, and continuous reputational damage says it isn't so certain it will. If you enjoyed this deep dive, smash the like button and subscribe. It really helps us out. We do these deep dives every single week and have so many more prepared for you. Make sure to check these other videos out for more corporate downfalls.